Good morning, everybody. Hopefully, you had a wonderful weekend. We're kind of running out of summer weekends here in the north part of the country. So hopefully, if you're up there, that you are out there enjoying it. So got kind of a fun, I think, presentation today, coaching call today, and there is a tool that I think you're gonna find highly necessary, or a slide you're gonna find highly necessary with your clients here towards the end. So. 5Q breakdown last week was listen to an advisor transition from beneficiaries to investments. Was it smooth? Because a lot of guys, and I talked to Jeff, you're worried about, well, how do I go from one topic to another topic? That's a good tape to find to really figure out how you do that. So take a listen to that. So here's a question for you guys. Which is better? An investment guaranteed to earn you $1 on your original $100 for a total of 101. Or an investment with a 50% probability of you going from 100 up to 202, and a 50% probability of a total loss. Which one of those is better? Okay, I'm getting most of you are saying number one. It ends up being they both have an expected value of 101. So mathematically, guess what? They're equal. They both have a mathematical value of 101. They have an expected value of 101. So they're basically equal. But so as far as better, it depends on what your definition of better is. So when you ask which is richer or riskier, which one is riskier? Number one. So those of you who said number one is better, what you're saying is if they are both equal, if the expected return of both of them are equal, then you want the one that is what? If the expected return of two investments is equal, you want the one that is what? Riskier or less risky? Yeah, safer. So that's why instinctually a lot of you chose number one. So good for you. So here's another little investment riddle. So and again, there's no math required here. It's just some of you will relate to this. So most people rarely give it much thought. Why is it that you hear people bragging about earning 10% last year with a portfolio of primarily biotech stocks or high-flying tech stocks or cannabis stocks, even as the S&P 500 only earns 7%? Only on 7%. This is right from a blog that I took this from, which is down here. Man, I was killing it last year. Have you ever heard this from somebody at a party or golfing or whatever? Man, I'm killing it this year. You ever hear that? Anybody ever hear that? Yeah, all the time. So this Warren Buffett wannabe says, I'm killing it. I beat the S&P 500 by 3% last year. That's 43% better than the market. I'm killing it, he continues, holding up his hand with a high five for his long-suffering friend who's heard these stories for years. Of course, he never tells them about what? All the stocks he's lost money on. But even if let's just talk about this stock. Let's assume that this is the only stock that he bought, and he did beat the market by 43% last year. There's still a problem with that. What's the problem? Well, the risk-seeking investor who managed to earn 10% in his biotech stock portfolio did a very poor job of stock picking. He earned 43% more than the S&P 500, but he took 93% more risk. So again, great, you earn more, you earn 43% more, but you took twice as much risk as the extra return got you. So based on a trailing 3-year measure of the standard deviation of volatility, he'd been better off buying the S&P 500 using a leverage to adjust the portfolio volatility to reach his desired risk level. He'd have earned 13.5. So if he would have used options to adjust the risk level, he would have earned 13.5% in his leveraged S&P 500 portfolio, but handily beating his 10% return. So instead of his 10%, he'd have gotten 13.5, which is actually almost double what the market did. So if you compound that by 20 or 30 years, how many tens of thousands of dollars is Warren Buffett wannabe leaving on the table while he's taking more risk? He's oblivious to financial loss because he does not understand risk. And that's the problem. Risk assessment is rocket science. Is risk a 10 question questionnaire you give your clients? Is that what risk tolerance is? Risk tolerance questions best determine client portfolio allocations. That is 100% what? BS. Why? Why is it BS? Beware of this is from Barron's. Beware of the wide divide between perceived and actual risk tolerance. A lot of our clients perceive that the risk tolerance is where? High or low? Well, some of them are low. Most people that I've, a big chunk think that their risk tolerance is high. But in reality, it's so good for the ones that have low risk tolerance. They're the smart ones, especially as retirees. But the ones that have a perceived high risk tolerance, what happens when they lose 50% of their market? What do? Yeah, they freak and leave. If all they did was scream and freak out, that would be okay. But what do they do when they scream and they freak out? Do they leave it in there? No, they sell low. See, people have misconceptions, tons of misconceptions about risk. And things that they think are absolute, written in concrete, are not. For example, let's just talk about a few things. What's riskier, stocks or bonds? What's riskier, stocks or bonds? Nick, you got it right. Ron's got it right. Bob's got it right. Oh, you guys are so smart. I got two yeses. What's riskier, stocks or bonds? And they said yes. Or I've got depends. I got both. I got bonds. Depends is the right thing, because what's your risk? I mean, what's your time table? Over 1 year, stocks will be riskier. Over 5 years, stocks will be riskier. Over 10 years, stocks are riskier. But by you reach 20 years, guess what? The difference between risk in stocks and bonds has gone to what? Equal. So it depends on which one is. But if you ask first of all, if you ask a huge chunk, a vast majority of advisors, what would they say to that? You guys are smart. I've been harping at you forever. But what would the vast majority of advisors say? Are stocks or bonds more risky? What would the vast majority say? Yeah, they'd say stocks are. Oh, which one gives you a higher return, stocks or bonds? Again, it what? Yes, it depends. Look at this. Past performance. Bonds have beaten the crap out of stocks over from 2000 to 2013. They beat the crap out of them. Now, of course, where are bonds right now? Will this ever happen to bonds again in our business lifetime? No, because obviously, as the interest rates were going down, bonds were going up, and stocks were suffering here. But now that we're down here, are we going to see this chart go right here into like negative 15 territory with interest rates? No, there's only one way. I mean, we're looking at 100 years, over 100, 120 years of time here, and it's at the lowest it's been in 120 years. There's only one direction the interest rates are going to go, and that's what? Up. So we're not going to see this again. But again, for people to say concrete rules of stocks are riskier than bonds, or that bonds perform worse than stocks, are those true? All those things that investors think, are they true? No, not at all. It depends. All of these things depend. How about the longer you hold stocks, the less riskier there is? True or false? You guys are so smart. You're all saying false. Stocks are riskier the longer you own them. 1 year, 10 years, 30 years. If you own them over 30 years, stocks becomes riskier. Why? Why do they become riskier over time? Why do they become riskier over time? Think about this. Do you know what you're going to be doing a minute from now? Do you guys all know what you're going to be doing a minute from now? I hope so. Yeah. Do you know with pretty good idea what you're going to do tomorrow? How about next week? What's happening to your idea of what you're going to be doing how about next year? How about 10 years down the road? The further we go, what happens to the certainty of our future? The further we go, what happens to the certainty of our future? Becomes less certain. It's no different for the market, guys. The longer we go, do we have any clue what the market's gonna look like 10 years from now? I mean, so the further you go, I mean, right here it's sharp. The further we go down the road, though, guess what happens? The future becomes blurrier and blurrier, and that's the same thing with the market. But what most people are saying are what? But man, I'm doing okay. Look at all these great returns I got over the last, couple decades. But are you really doing good over the last couple decades? So the S&P 500 ended 1999 at 1469. It was recently at 2814. That's an increase of almost 92%, almost doubling. Over nearly 19 years presented in the table, it represents the average annual return of 3.5%. That's well below the average annual gain. So did really, guys, have people done well, or have they over the last 2 decades, or have they done well over the last decade? That's a good example of what? Over the last decade? Yeah, you're doing awesome. So was there more risk over the last 2 decades or over the last decade? Was there more risk over the last 2 decades or over the last decade? So apparently the whole adage of stay in longer is what? If you stay in long enough, stocks will be what? And is that true? Not true at all. The longer you have stocks, the more risk there is. See, again, you've heard me talk about this. We are right now in a storage shed with all these old papers and all this dried out tinder. We got all these things plugged in an electric socket and a gasoline can. Does that mean that the shed is going to go up in smoke? No, but not at all. It does mean that how much wiggle room do we have for something to go wrong before it does blow up, though? Yeah, we have virtually no wiggle room. So there are known knowns. There are things that we know. There are known unknowns. That is to say, there are things that we know we don't know. But here's the thing. There are unknowns, things we don't even know that we don't know, right? And how many of the stock market corrections, over a dozen stock market corrections we've had in the last 120 years, how many of them are identical? That the cause of the correction was identical. How many of those 12 were repeated? None. So guess what's going to cause the next stock market crash? Nobody knows. You can't guess. You can't guess because anything that there's never been. This happened. We're going to have a stock market crash. That's never happened. Whatever causes stock market crash is always new and fresh. Something. Oh, great, a new problem. Does that make sense? It's a new problem. I mean, it could be what? I mean, have the U.S. and Russia aircraft been playing a dogfight with each other over the last year? What would it take if one of those guys did some boneheaded thing they've gotten how close to each other? And if that happened, what would happen? Yeah, oh my. We got North Korea. We've got the Hong Kong. Now here's the thing. I was listening to 2 different economists, and they said if China came over and took, it said not so much like a Tiananmen Square, but China did then usurp and remove Hong Kong's democratic ability. If they usurped for what, peacefully, unpeacefully, doesn't matter. Doesn't matter whether it's peaceful, unpeaceful, whatever. But if they take away Hong Kong's democratic abilities, what would happen to the U.S. markets? It would dwarf the problems we're having with U.S. and China tariffs. It makes the tariffs look like a pimple on a rhino's butt. That if China took away the democratic process in Hong Kong, because of all of the international financial tendrils that go through Hong Kong, are there a lot of financial tendrils that go through Hong Kong? Yeah, so much runs through Hong Kong that if China took that over, that those financial tendrils would be severed immediately. And guess what that would do to the financial markets around the world? It would blow them up. So that's some things that could go wrong. But wait. If we get in trouble, the Fed will fix it, right? That they always do, right? They'll step in and lower interest rates. What's the problem with that statement, guys? Because in the past, when we've had market crashes, when we've had recessions, the Fed has stepped in and lowered interest rates. What's the problem with that right now? Yeah, there's no dry powder left. They can't go lower. There's no room. So we're in a very, very dangerous situation that if we go into a recession, how long is that recession going to last? Do we have tools to get out of a recession? Can we lower taxes again? What happened? I mean, the taxes that they lowered 2 years ago have caused, did that cause an economic boom where all these extra revenues are coming into the coffers? No. So everything that they said was going to happen with those taxes, that debt has gone what? What are we looking at U.S. debt right now? It's blowing up. Trillions. That's what we're looking at for U.S. debt. So do we have room? Do we have anything in our toolbox to fix a recession right now? No. That's problematic. The Fed can't stop a market meltdown, Warren's forecast true, called the 2008 housing bust. So James Stack was interviewed. He said in an interview with Market Watch, he suggested, will the reversal in Fed policy that began last year result or re-stimulate economic growth or simply reinflate investor exuberance? That's, as he notes, the last 6 months have delivered the strongest stock market gains. So why have we seen these 6 months, these gains in the market? Because companies have magically over the last 6 months become more profitable? Is that why we've seen these gains over the last 6 months? No, it's because the Fed raised interest rates. Trump bullied them into lowering interest rates, which they did, and that put, it's like have you ever heard the analogy where you see somebody and they got rosy cheeks and you think they're the what? That's the epitome of health. Look at those healthy, rosy cheeks. Really, what's happening? Why are their cheeks rosy? Because they've got a fever, or they got high blood pressure, right, Till? But they look like the epitome of health. Nice, rosy cheeks. It's a fever underneath. So they look terrific for how long? For now, Stack says, he says, watch the warning signs that are already creeping up. Weakness in small cap stocks via the Russell 2000 and transportation names, softness in the manufacturing sector. So it looks great. It looks great, but underneath, if you look underneath, if you take the temperature of what's actually happening and the indicators that warn of a big correction, small caps are not doing well. Transportation is not doing well. And I won't go into it. I could spend a whole hour on why. Do you all understand why, if transportation is not doing well, why that's bugling a problem? If you don't, you should research that. Softness in manufacturing sector. The bottom line message from past history is that if we're on a recessionary course, either by the level of debt or the level of overconfidence, do we have a level of debt? We're going to talk about that in about 2 minutes here. Do we have a level of debt right now in the U.S. government? Massive. Do we have a level of debt with the consumer? Massive. Do we have a level of overconfidence right now in the economy? Yes. The Fed may not be able to prevent it even with multiple rate cuts. And can they do multiple rate cuts, guys? No. If the downturn, he said, if the downturn takes back just half of the current bull market's gains, just half, it'd mean a loss of 40%. How many of your clients are ready for a 40% loss of their portfolio? The market has a technical problem, making it vulnerable to a rapid sell-off, says J.P. Morgan. So now we got J.P. Morgan saying it. And what they're saying is this. They're saying it's shallow. The market's so-called depth is so shallow that increasingly vulnerable, exacerbated moves. So are we, this great returns over the last 6 months, is it because all stocks are going up? Or is it because the big stocks a few big stocks are going up? Is it because thousands and thousands of stocks are going up, or just a few? Yes. The increase in the market is very shallow, and that's a good sign or a very, very bad sign? In our mind, this persistent low market depth leaves U.S. equities vulnerable from here if central banks fail to validate market expectations or U.S. recession risks resurface. Says J.P. Morgan analyst Nicholas, say that name twice. The S&P 500 has risen a stellar at 19% this year, but the strong performance has been accompanied by light inflows. So that increase is because everybody's rushing, or it's just a little bit is driving that market up. Light inflows and trading activity, as well as low market liquidity, analysts point out. The average market depth has been close to historical lows. That, guys, the market depth is near historical lows. Good or bad? National Review. Is the National Review a liberal or a conservative point of view? Liberal or conservative? I got two answers. Everybody else is confused? The National Review is very, very conservative. Yeah, conservative. So, Ben Carson has joined the community to reinflate the housing bubble. The Trump administration is vastly expanding the scope of condominium purchase eligible for low down payment loans. The move to be announced Wednesday by Federal Housing Administration could help revive the entry condo market for the first-time buyers because FHA bank loans require only 3.5% down payment and lower credit scores on conventional loans. It also loosens financial crisis era. Only 10 years ago, guys, financial crisis era rules. Guess we learned our lesson, didn't we? And could expose the government to a higher probability of loan default if the housing market continues to slow and prices fall. So let's assume inverted yield curve. Oh my God, can we assume an inverted yield curve, guys? The Merrill Lynch Index. So unpredictable economic weather. What better time to put the American taxpayer on the hook for a brand new batch of dodgy condo loans for some scrubs with bad credit who can't be bothered to save up for a proper down payment? Everybody makes mistakes. Making the same mistake over and over again is stupidity. Being stupid with other people's money over and over again is politics. It took, guys, how long ago did this kind of crap just happen and nearly sink the U.S. economy and the world economy? How long ago? 2008, 10 years ago. 10 friggin' years ago, and we're doing what now? Same thing. I talked about this 2 weeks ago, so a little predictive. So I actually showed you this curve 2 weeks ago. Did anybody see this curve last week? So I beat the U.S. I beat all the big pundits by a week showing you this curve because this is what the inverted yield curve I was pointing out 2 weeks ago. And lo and behold, did it create a problem just like I predicted 2 weeks ago? So why is that a problem? An inversion of the yield curve and a signal of lower inflation typically accompany a lower economic growth. It continues to slow down in growth. It validates falling yields and sets up the stock market drop. So guys, that's like, do you see how that it's the death spiral? An inversion yield curve and a signal of lower inflation typically accompany lower economic growth. A continuous slowdown in growth validates falling yields. A falling yield sets up a stock market drop. Do you see how it's a death spiral? One creates the other, creates the other, creates the other. So what if this ever slows down? Guys, you know, one of the reasons we've seen fantastic market returns the last 2 years is why? What was the tax break supposed to do? What was the tax break supposed to do? It was supposed to infuse all that money was going to go to buying for companies to what? Invest in more companies, invest in more real estate, invest in more production, invest in themselves, invest in more hiring more people. What did they? And many people, including myself, said that's bullshit. You know what they're going to do with that money? Guess what they're going to do with that money? And what did they do with it? What did they do with it? They bought back. Hey, I love it. Freaking A, I love it because all my stocks went up. Why did all my stocks go up? Because the companies were much more profitable or because they're buying back shares? What's going to happen to buying back shares when there's no more? And have we seen a lot of what's happened? I mean, have the companies already taken advantage of those tax breaks? So is this going to continue, this buybacks? No. So that what we've seen was artificial. Look at this. Here was the mortgage in 2008, 2009. Where is the mortgages now? Higher than it was in 2008. And is it because people have been buying houses? We're back. Guess what? We're back to doing. Guess what? Most of this is from again. Not only did the U.S. government not learn anything, we didn't learn anything. People are refinancing their homes to do what? All sorts of crap. Which means what's happened to the equity in their homes? Revolving credit. Where is our revolving credit balances now as compared to 2008? Higher. So what's the problem with all of this refinancing and people having a higher mortgage and higher credit card debt than they've had in 2008? What's the matter with that? Why does that cause a problem? What percentage of our economy is run by consumer spending? If they've refinanced their homes and their credit cards are maxed out, what does that leave for them to spend? Nothing. And if we have a recession, that means we're going to be filling more jobs, or we're starting to peel jobs off. And what's going to happen to wage increases? So what's that going to do to the economy? And guys, bear markets, 29, 86%, 37, 60%, 29%, 20%, 28%, 22, 36, 48, 27, 33, 20, 49, 56%. I don't care any of these numbers, how many of your clients are going to be able to weather these kind of downturns? And I'm just going to tell you, if your money manager tells you they've got an algorithm, a computer program, or a friggin' crystal ball that's going to help you avoid the market downturn, they're full of what? Here's a witch's tip. Whenever you're not using your crystal ball, cover it with a dark cloth, partially because it's special and magical, but mostly because it's a double convex lens that when a ray of sunshine goes through it, can act like a magnifying glass and set your you-know-what house on fire. Do magic, do crystal balls work? Don't think you can avoid market crashes by getting out of stock before one. That's market timing. It rarely works. Index fund pioneer John Bogle has quipped. Sure, it does. It'd be great if we get out of stocks at a high and jump back in at a low. But in 55 years in the business, I not only have never met anybody who knew how to do it, I've never met anybody who had met anybody who knew how to do it. So if your money manager says they know how to do it and they're accepting a client with $1 million, you know they're full of what? If a money manager could actually do that, what would be their minimum client size? Yeah, $1 billion. Exactly right. Various studies have supported that position. Index fund advisors, for instance, noted that in 20 years, from 1994 to 2013, the S&P 500 averaged an annual return of 9.2%, enough to turn $10,000 initial investment into $58,000. But any investor who missed just 10 days of the biggest gains would see their average return fall from 9.2 down to 5.5. So they would have missed just 10 days, accounted for half of the annual return that these places got. Who's smart enough to know to be in during the 10 best days over a what is that? 20-year period, the 10 best days to make sure they are in for the 10 best days during a 20-year period. Yeah, Buffett just stays in. That's right. And then you have these guys that say, well, okay, I know when to get out and I know when to get in. So look at this. Okay, we need to get in because the market's up 48%. Now, the bear market's over. We need to get back in. Oh, shit. Oh, wait, the market's back up 12. It's time to get in. Oh, crap. Oh, market's up 21%. Oh, crap. Oh, well, the market's 27%. Now's the time to get in. It's got to be the time to get in, right? Oh, wait, boom. Well, now, hey, let's face it. Now's the time to get in. Look at how much it's down, and it's up 35%. Now's the time to get in. Oh, man. Guys, do we know when to get back in? Oh, wait, but you're saying, well, Mike, that's 1932, 29. You know what? That's old time. Okay. Let's look at current time, 2000 to 2009. Okay, the market went down, but it went up 30%. Now it's time to get in. Or, well, I'm sorry, it went up 17% right here. Now it's time to get in. Oh, wait, it fell again. Well, no, wait, it's up 13%. Now it's time to get in. Oh, shoot. Oh, it's up 24%. Now it's time to get in. Oh, doggone it. Well, look, it's up 32%. Obviously, now's the time to get in. Ah, shoot. Oh, yeah, well, now, obviously, it's time to get in. It's up 93%. Of course, we got to get in, got to get in. Oh, man. Do we know when to get back into the market, guys? When do we know when to get back in the market? Do we know to get back in the market here, or here, or here, or here, or here, or here? When do we know to get back in the market? Historically. We know to get back in the market. I do know to get back in the market right here. Of course, I didn't know that I need to get out right here, but I do. Oh, shoot, I should have been in for all these years. Guys, do we know when we're supposed to be in the market? This is the slide I was talking about. So all those people that want to believe that there's a way to know when to get in and out of the market, this slide proves that that's what. Everybody answer that. Anybody who believes that they know when to get in and out of the market, this slide is proof that what? Unless your money manager can prove to you that they got out here, in here, out here, in here, out here, in here, how many of the your money managers did any of these 1, 2, 3, 4, 5, 6, and did any of these 6 trades properly? Everybody answered that. I want to see all 150 people tell me they didn't. Keep going, guys. Just put zeros. Nobody can do this. And Marcia sent in this from the Wall Street. About to retire? Check your stock exposure. So thanks, Marcia. We had our theoretical investor retire 2,000 with 500,000 fully invested in S&P 500 using the 4% rule. That nest egg eroded to less than 200. They started out with 500,000 in 2000, and at just 4%, they ended up with 200,000 by 2018. Why? Although the S&P 500 produced a 4.86% rate of return. So guys, if the market's giving you a 4.86 and you're only pointing out 4, you should be okay, right? Why did they lose well over half their money? That's right, sequence of return. Sequence of return. So am I only showing you liberal insurance-oriented websites, guys? What is everything that I've shown you today? Liberal bond and insurance-oriented websites, or are these conservative stock-oriented websites? And what are they all saying? Till, what is it? Great, Till, educate me. What are which one of the ones were liberal? Because I've only shown you stock-oriented, conservative entities. And they're all saying what? Oh, Till's saying the Wall Street Journal is liberal, guys. What would you say to Till? Till, you probably don't want to see what everybody's saying right now. Better safe than sorry. How 3 allocations fared for someone, and this is from Wall Street Journal again. Conservative, 30% stocks, 7% bonds. Balanced, 60% stocks, 40% bonds. Totally in the market. Which would we be better right now? Which would have been better? Oh, and by the way, what's better than bonds, guys? Yeah. What would this line have looked like instead of being 30% stocks and 7% bonds? What would this line have looked like if it's 30% stocks and 70% FIAs? It would have been way up here. So I have Jeff, can you get on a second? I have guys ask me, well, Mike, you always say 50-50. You always say 50-50. What if my clients want more than 50% in their portfolios? Jeff, when we talk to all of our guys, do clients normally want to go 50-50, or do clients normally want to do way more than 50% in FIAs?
Oh, they usually want to do way more in FIAs.
Yeah, I just say 50-50 for all the asset managers that are just worried about losing assets under management. But when you ask a client, when we look at over and over and over at our advisors and the client base, they don't want to do 50-50. They want to do way more than 50% in FIAs. And according to this, is that a good or a bad thing for the clients to want, guys? So it's a very good thing. So whether or not investors use these funds, they should think about their current allocations and consult their financial advisor. The question they need to ask is, if they're going to the traditional route and consuming 3 to 4% of their saved assets every year, do they really want to bet the bull market will continue? Guys, we don't know when the bull market's going to end, but again, we are in record territory. We've never had a longer bull market expansion, never. So are we nearer to the end or the beginning of it, the bull market? And again, this is Morningstar and this is Wall Street Journal. Are these entities that are pro stocks or pro bonds? Pro equities or pro putting your money into CDs? And they're saying what? Beware. So low risk composure makes tolerable portfolios seem scary. Low risk composure makes tolerable portfolios seem scary. What they're basically saying is this, is that people, if you have a low risk portfolio, how much braver does that make people? If you have a low risk portfolio, how much braver does it make it? Yes, they can withstand when the market falls. They're not the ones likely. If they have a more conservative portfolio, are those people more or less likely to yank out? So somebody with a 50-50 portfolio, if the market falls 50%, are they more or less likely to yank their money out? Less likely. And if they have a 90% of their money in stocks and bonds and they're both tanking, what's likely to happen? And those of you that have experienced this, and again, I've been investing for 45 years, so I've experienced it with myself and the people around me and the people I've trained in the last 20 years. When people are way overweighted in stocks and bonds and they crash, do they say, I'm going to just pull out 50% of my account, or do they pull out all of it? They pull it all out. But if you got at least 50%, or as we saw in this last slide, how much? 70% in FIAs. What's likely to happen with that money in the market? Are they going to yank it out, or will they give it more likely to let it ride, buy and hold, and let it come back? Yeah, they're going to let it ride. So the biggest thing that we have right now, though, is when the market gets volatile, what do people say when the market goes down? What do people say when the market's down 10% or the market's down 20%, the market's down 30%? What do they tell you? I got to what? I'm going to move it as soon as what? Yeah, most are going to get out. Most are going to get out. Now, like when we have like last week when they're down 3 or 4%, what do they say? I got to wait till I get back to zero. Yeah. So when the market's down 40%, when it's too late, they're going to yank their money out. But on the way down, when we're looking at these, what they say, oh, I got to wait to get back to ground even, then I'll sell. And then do they sell when the market went back up 17%? No, they don't. And oh, shoot, it went down again. Oh, you know what? I'm going to sell as soon as I get back to ground zero. And then when it gets back to ground zero, do they sell? No. And then it goes down 7. I've learned my lesson. I'm going to sell this. Guys, this is how people will make stupid decisions all the way down to the bottom. So the great thing about the FIA is if stocks are up, is the FIA a good place to move their money? Yeah, because what will happen if the market continues to go up? What will happen with their FIA? It'll continue to go up. If stocks are down, is the FIA a good place to put money? Yeah. See, for the people we work with, are they looking for the highest rate of returns, or do they want a mistake-proof portfolio? Mistake-proof portfolio. So when people are saying, shoot, I know you're right, I want to do this, but I got to wait. All you need to do is say, okay, we need to wait until what? And whatever they say, you can say, super, you got a crystal ball. Let's leverage that. You're convinced the market's going to go back up. So let's go ahead and take a mortgage on your house. Because if the market's going up, let's leverage that to the get-go. Oh, yeah, because we don't really know, do we? So what we want to do is, do we want to be right if the market goes up? Do we want to be right if the market goes up? Yeah, we do. Do we want to be right if the market goes down? Yeah, we do. So we want to make sure we don't do what? Well, we don't want to make a mistake. Okay, so what's the only thing that if the market goes up, you're going to be okay? If the market goes down, you're going to be okay? And that we can't make a mistake with. So when do you think we should move? Because unless we can see in the future, what's the only thing we can move to that's going to be, that'll do okay if the market goes up, will do okay if the market goes down, and is mistake-proof? What's the only thing we know? So where do you think we should move? So that's how you handle it when they're like, I want to do this, but now is not the right time. Does that make sense? Super. So when you mastered all the things we've been talking about forever, and which is what I hope you spent your summer doing, that's when you're going to get people to move all of their money to you. And as we learned today, at this point in time, a big chunk of that money should be where? FIAs. Mistake-proof. Make sense? Super. I got on my soapbox today, but gosh darn, guys, I think now, I mean, we're in that room with newspapers and gasoline, and we don't know when it's going to go, but we need to be right all of the time, and there's only one way to be right all the time, and that's 50-50 or more portfolio. All right? You guys have a great rest of the week. We'll talk to you all next Monday. Thanks, guys.